Your time.
Thank you.
Now, not everyone agrees that the rising rates won't kill the housing recovery. So here with the other side of the argument is Dani, Babb founder and CEO of the Babb Group. Welcome to the show. Let's get right to it. What did you agree with and disagree with of what you just heard?
Well, I disagree with the notion that rates will not have an impact on demand, but I agree with the concept that overall housing is going to see a decline both in prices and in demand overall.
Why do you think that?
Well, there are several factors at play. First of all, if we just look at the interest rate factor, which was first addressed, that Dick had addressed, the interest rates, though, if you look at the past 30 years, for example, there's not a direct drop or a correlation between interest rate increases and a drop in demand. However, there is a correlation between the affordability of a home, the affordability index, interest rates, and therefore overall demand for homes at various price levels. So what tends to happen as interest rates go up is people either, one, delay their buying decision, two, they don't buy at all, or three, they buy something that's much cheaper than they would have in the past. So for example, if a person was buying a $200,000 home in May of this year, they would have paid about $875 a month, and today they would pay about $1,025 a month. And to think that that's not going to have an impact on mainstream, I think is incorrect.
But Dani, I mean, one thing that could happen is that as interest rates go up, maybe prices don't rise as rapidly. We have seen a big move up in prices that some think signal another bubble. So maybe, I'm just being the devil's advocate here, maybe if rates rise just a little bit, that will stop this from becoming another bubble. It could be a good thing.
Yeah, no, I actually agree with you overall in the concept that we do need rate increases so we can find a new healthy market equilibrium. What's been happening across the country with only 4 months of inventory, which is about 2 months shy of a healthy market, some would argue 3, is that the areas that had been hit hard by the bubble last time are being hit hard by a potential bubble this time. And the quote of 12 to 20% and so on of prices increasing in some areas, we're seeing that 200% in 1 year. And that's really a significant problem, particularly when we have a lot of cash coming in from Asia. So I do think overall we need rates to increase. We need the Fed to buy less than $85 billion a month in bonds. We need rates to come up a bit so that the market can return to something healthy. Unfortunately, for people that are existing homeowners trying to sell, that is going to mean a lower price, and it will mean, I believe, less demand overall in the market.
I mean, that's incredible. What you said strikes a lot of fear in people's hearts. When they think of the Fed getting out of this situation, they are very concerned about the housing market. I mean, one more time, why should we not be worried about that? Why does the Fed beginning to exit not spell death for the housing market?
I think it is going to drop prices overall in the housing market. So if we're going to correlate, the death of the housing market with a drop in prices, I do think we're going to see a significant drop. Yeah, it's a good thing long term. It's not a good thing if you're holding now, you're trying to sell now, or you've been an investor in the last year and you're going to try to get out of the market in the next few months. It's not going to be positive for you. But overall, if we want housing to return to a not bubble-like environment, that's what we have to have in the market.
Okay, Dani, thank you so much for coming on the show.
It's going to sting to get there.
Okay.
Thank you.
Next on